In 2025, the US government suddenly looked more like a strategic investor than a regulator, taking stakes in Intel, MP Materials, Lithium Americas, and even getting a golden share in US steel. Is this a return of big government to markets, or just normal industrial policy? And how does that compare to how China moves its pieces on the chessboard? Let's unpack it. I'll summarize each major US move, explain the stated goals, show the financial mechanics, and then compare this to China's state-driven market interventions. Stick around. I'll end with the big takeaway for investors and policymakers. First, Intel. In 2025, the US converted billions of dollars of previously promised chips and industrial support into an equity stake, roughly a 10% non-voting stake worth about $9.8 to $11.1 billion, depending on which reporting you read. The government framed this as securing domestic chip capacity, not as a profit-first investment. Second, MP Materials, the owner of the US's lone large rare earth mine. The Department of Defense invested roughly $400 million and took about a 15% stake tied to magnet production and supply chain guarantees, a national security play to reduce reliance on Chinese refining. That deal included commitments for new magnet plants and price support mechanisms. Third, Lithium Americas. The Department of Energy restructured financing around the Thacker Pass lithium project and secured a cash 5% stake, plus a 5% stake in the GM joint venture via warrants or options tied to loans. Again, framed as securing domestic battery-grade lithium for EVs and national security. These were described as no-cost warrants or equity as loan restructuring collateral. Fourth, U.S. Steel. Not exactly a cash purchase, but the administration negotiated a golden share alongside Nippon Steel's takeover. That gives the U.S. government veto rights over certain strategic decisions, a control mechanism rather than a conventional equity investment. So, Intel, chips, MP Materials, rare earths, Lithium Americas, lithium, and a golden share in U.S. Steel, each targeted at critical supply chains: chips, magnets, batteries, steel. Why now? 3 reasons: national security, supply chain resilience, and industrial policy to keep strategic manufacturing onshore. The government frames these purchases as investments into infrastructure and security rather than market speculation. Mechanically, the government used conversions of grants, loans restructured into warrants, direct Department of Defense equity, and regulatory leverage, golden share. Those tools let the government gain influence with limited upfront cash outlay, or as part of protecting taxpayer loans. Now compare China. Beijing uses a denser web: state-owned enterprises, SOEs, state investment arms, and state funds that both own and direct companies, and they frequently buy shares to stabilize markets or pursue industrial policy. In 2025, China's state holding companies publicly pledged to boost share purchases to stabilize markets. China's state funds will often buy shares to calm markets or push industrial plans forward. The U.S. in 2025 used purchases more as strategic cushions tied to grants and loans. So what should investors watch? First, political risk. Stakes held by governments can politicize corporate decisions and create regulatory uncertainty. Second, sector signaling. When a government takes a stake, it signals priority. Expect more capital flows, subsidies, and preferential contracting. Third, market distortion risks. Price floors, offtake agreements, and government ownership can change incentives for competitors. Bottom line, 2025 was the year the U.S. used equity and creative deal structures to secure chips, magnets, lithium, and control over critical industrial assets. It's not a wholesale turn into a sovereign investor like China's state apparatus yet, but it is a material shift toward using capital to meet security goals. Expect debates. Is this smart industrial policy or creeping government ownership? Let me know in comments.